All right, perfect. Let's start. I would like to apologize in advance. My voice is quite affected, but I didn't want to postpone this webinar because it should be a ton of fun. So as always, I wanted to welcome you to another edition of Into the Blocks webinar. We try to cover cutting edge topics in the digital assets space. Today, specifically, we're going to be talking about a subject that is very dear to our work here at ITV, that is related to risk monitoring and management in DeFi. The agenda is fundamentally simple, so we're going to talk about um, understanding the characteristics of risk in DeFi. This is a key point. I want to spend some time presenting a framework that will help you think about the different approaches to manage risk in DeFi. Some practical examples, particularly related to the work that we have been doing in this space. And at the very end, I want to present one ambitious idea that still no idea if how practical it is at this point, but it's something that is definitely technologically possible, right? And it's definitely worth exploring. As always, I want to start with a 30-second update about Into the Block. In the last 3 weeks since our last webinar. So in the next week, you're gonna see a release of a number of high quality indicators in our analytics product. We're launching a lot of super sophisticated indicators in areas like staking and things like that we worked really hard on and should provide some very unique insights into the market. In our risk radar product that we're approaching launch day, and you're gonna see some of the metrics. Next week we're gonna be releasing an alpha preview of risk signals for Curve. It's a very computational, complicated model that covers all Curve pools across several blockchains. So it should be, and then we also gonna be releasing Avego, the new programmable stablecoin. And then in our Smart Deals platform, this is a platform that was run quantitative strategies on DeFi for large institutions. We just did this release that we allow you to essentially manage the entire life cycle of positions from where you want to deploy more capital, withdraw. Is completely non-custodial, one click at a time. You can manage the entire life cycle of the positions. Is something that has been super well received by our clients. So in terms of other updates, we added a ton of new quant strategies to our Smart Deals platforms. We're about to unveil analytics for Arbitrum as well in analytics, and we have, I cannot tell you how many protocols we have partnered with for the risk radar for monitoring risk. It's gonna be a super exciting release. We're going to market with all the top protocols in the space. All right, so let's start. Let's go to the key topic. Let's talk about different ways to think about risk in DeFi. One thing that is pretty obvious when it comes to risk in DeFi is that it's completely different than traditional markets. So traditional risk theory in traditional finance is all boils down to the economics Nobel Prize Awards of 1990 that was awarded to Harry Markowitz, Merton Miller, and William Sharp for a sort of combined work across different areas of risk returns portfolio. So in the 1950s, Harry Markowitz came up with this idea of portfolio theory that is still very in use today. One of his students, William Sharp, improved on that, creating the capital asset pricing model that essentially allows you to model risk and returns on top of a portfolio. And Merton Miller did an optimization on that related to in terms of loans versus equities in portfolios. And the combined work of them was awarded the Nobel Prize in 1990. But fundamentally, most risk models today in traditional portfolios are based on this. So DeFi has nothing to do with volatility. It has nothing to do with traditional portfolio theory. So the reason traditional risk models work is because it assumes that there is a lot of intermediaries that this risk. That if you're using an insurance company, if you're using a prime broker, then you're assuming certain level of trust, and that trust this risk certain aspects of the trade. But in DeFi, when you remove all that and you're operating with the smart contracts, effectively what you're doing is you're moving that risk down to the smart contract layer. So definitely risk takes a very different connotation in DeFi. So key point here, DeFi risk is about many things, but it is not about volatility. There are many frameworks to think about risk in DeFi. This is one that works very well for us. I think there is three fundamental. I even wrote and published an article in CoinDesk about this. There are three fundamental dimensions that encapsulate most conditions in risk in DeFi. One is technical risk. These are hacks, right, to protocols, to smart contracts exploits. Governance, manipulation risk, and what we call economic risk, that is, the protocol is working just as planned, but there are different economic exploits. I think that the combination of the three capture most risk vectors in DeFi. So technical risk refer to the ability to exploit security vulnerabilities in a smart contract. So, we all know, we all read all the hacks, all the exploits that have happened over the last few years and continue to happen. And here's an example of Euler that I'm actually gonna show you some data about it, but this is your vulnerability in a specific smart contract in a protocol that gets exploited. Governance risk is the type of attack, the type of risk in which different parties can manipulate governance votes in their favor. Most governance models in DeFi are very basic, like one token, one vote type of thing, and therefore many holders can manipulate that. So a very famous attack happened last year when Beanstalk was exploited by 182 million with a governance proposal that got approved immediately, and the attacker was able to withdraw a lot of funds. Now, economic risk, we think, is the peak of the pyramid. It's probably the most important. One, that the protocols are working as planned, no exploits or anything, but there is a lot of, given the composition of the protocol, you can exploit it in different ways. And this takes from Oracle manipulation attacks to all sorts of things, slippage, or all sorts of different, and this happens every single day in DeFi. So when you put those in a comparison, these are different factors that might help you assess how to think about it. So there are 4 dimensions that we think about: how frequent those attacks happen, what is the current impact today versus the future, and how predictable they are. This is I think it's a decent framework. So technical risk is not very frequent, so it's very binary. Obviously, we don't get hacks every day, although sometimes it feels that we do, but we don't. The impact today is very high, right? Like most of these attacks are successful, but we hope, right, that DeFi protocols are going to get more robust in the future. So the impact in the future should be low. If not, we're going to have more serious problems, and the predictability is very low. So be very skeptical of any framework that tells you that they predict hacks in DeFi and things like that. There is not enough data to create predictive models about this thing. So you put all the hacks together in DeFi and they amount to a few hundred, so that's not enough to do any predictive models. So in terms of the governance risk, the frequency is very low. There have been a handful of this. The impact today could be medium, right, with some exceptions, and in the future, obviously, governance is going to get better. Should be low. Now, this is super predictable, right? You can look at a governance proposal and pretty much get an idea what's gonna do. Now, the economic risk, this happens every day, multiple times a day. The impact today is high, and it's just going to get worse in the future. And then there is some things that you can do, and we're going to talk about it to predict it. But in general, there are many use cases in which it's not predictable. Now, our thesis about this is that over time, technical and governance risk should become more manageable, and economic risk should become worse and more prevalent. The reason for this is DeFi protocols are going to become more robust, more secure. Governance practices are going to get better. But then the asymmetries, right? If we have more protocols, you're still going to get these asymmetries in the market that are going to be conducive to a lot of economic exploits. Now, there are other forms of risk. Obviously, you have exposure to layer 1, layer 2, so you have market risk and other things. But in general, technical, economic, and governance risk encapsulate most of the risk conditions that you're going to see in DeFi protocols. Now, that's how do you classify it? Now, how do you manage risk in DeFi? What are the different approaches? Here, there is also another taxonomy that I think works for us. So, first of all, is how do you detect risk and what approaches do you have? There are three main groups that we can think of. One is rules-based, symbolic. One is based on simulations. One is based in machine learning. And then we have, most people think about risk about something that is encapsulated in a single protocol. There was an attack. But there are many risk conditions that combine different protocols. You might be looking at a protocol and other protocols that are related to it, or breaches or things like that. So typically, risk models are more complex. So single protocol, multi-protocol is also another good way to classify it. At least we find this taxonomy works for us. So one thing to know about risk in DeFi, it's very discrete. So for the most part, you can look at the data, the state of the mempool, the state of the blockchain, and get an idea what the risk conditions are. You don't need super sophisticated financial and predictive models. This is part of the benefit of a blockchain, right? You're seeing everything, so you can forecast very quickly by just running experiments. So the impact of machine learning models here, it should have an impact, but it's still TBD. At least predictive models. Other forms of machine learning are definitely very applicable. So let's start with the first one. So symbolic risk analysis is rules. You have known conditions, you model those rules, you monitor the data and go through those rules. So imagine a rule that is looking at different transactions, and it's going to look at if a whale is exiting a pool, if a liquidation could happen. Those are known rules, right, that we have, and you can hard code, and that could output a specific risk condition. Simulation is different. Simulation is you have a model that you know it works, right? And then, one thing, in terms of risk, symbolic risk, you have different models. So causality models in traditional statistics, with frameworks like do why and things like that work. Just simple rules-based models, if this then that type of approach, as well as a little bit more sophisticated logistic regression structures sort of work as well here too. So simulation is an approach in which you have a model and then you simulate a lot of random inputs, and try to come up with an output. This is used a lot by companies like Gauntlet or Chaos Labs to sort of come up with different scenarios for the composition of a DeFi protocol. Let's say you want to adjust the weights of them on a pool in an AMM or the collateralization ratio. In lending protocols, you run different simulations, many scenarios, and you come up with a risk condition. So the transactions here, the inputs are random. You need to simulate many scenarios, and then you come up with an output. Here, different techniques like random walks and Monte Carlo simulation that are very effective in this type of mechanism. Now, the machine learning is the opposite. So in simulation, you have a model that you know, and you have random inputs. In machine learning, you have a lot of known inputs, and you're gonna learn a specific a specific model. Deepak is asking about practical examples. Just give me a few minutes. I'm getting to that. In machine learning, you can take let's say a classification model that is going to tell you this transaction is risky or not, and then put a bunch of blockchain transactions and then run that classification model, and you're going to get an output. There's a lot of things there, right? Decision trees, techniques that work, convolutional recurrent neural networks that also work. Again, these are not predictive things. You don't need to predict a risk condition. More things like classification sort of tend to work a little bit better in these scenarios. Now, risk conditions in DeFi are very often not constrained to a single protocol. This is a mistake that we typically assume. So when you put all this together, right, there is also some factors that we like to evaluate. Each one of these techniques, how simple it is to implement and how simple it is to understand. Is it real time or not, right? Can you use it in real time? And how much risk can you really cover with this? So symbolic approach is just rules, so super simple to implement and to understand. It is real time, right? You can take a transaction and say, is this going to trigger a liquidation in a lending protocol? And you can cover a ton with that, right? You can cover a lot of scenarios. Simulation, there is a question about can we use an example. Simulations are very complex. These are used for, should we assign more weights to a specific pooling curve or not? Should we change the collateralization ratio of a specific lending market in Aave or not? These are difficult to implement and also difficult to understand because most of them obviously are not discrete and they're not real time. They're very easy. You cannot look at the mempool, run a simulation, and get an answer. It is just, it requires more computation like that. Now, how much risk you can cover with that is medium to low. Typically, it's about making sure that DeFi protocol has a composition that is reliable, but it's not about reactive real time. Like at Into the Block, we try, regardless of what the protocol is, we need to manage risk. So we focus more on the economic side. Now, machine learning is semi-complex. So there are some things that are super simple and some that are more. Now, they're definitely complex to understand. They can be executed real time. So today, technology is at a point that I can take transactions on a mempool, run it through a machine learning model, and get a risk output to that. And you can cover quite a bit. So within the combination of symbolic and ML, gives you a ton of coverage. And then when you think about the protocol surface of these things, many risk models are focused on a single protocol. So you're looking at liquidations in a lending protocol, you're looking at a slippage on an AMM, and some other things cover many protocols. You're looking at liquidations in a lending protocol, but just happen that you use a bridge to get to that blockchain for that lending protocol. So you're looking at activity in that bridge and things like that. Now, how does this relate one to another? So again, let's use five factors here. The techniques, right? Symbolic simulation ML and the risk vectors, technical governance, economic, union, multiple protocols. So symbolic rules-based, technical risk, it works right. You can look at a smart contracts, run a bunch of things. That's what auditors do, right? They run a bunch of tests and they validate certain conditions. In governance, it doesn't really apply that well, but definitely applies in economic risk, and it applies to both single protocol and multi-protocol. Simulations, it does apply to technical risk. You can take a smart contract and simulate a bunch of scenarios and try to output identified risk condition. It also applies to governance. You can say, well, if I change this composition of the protocol, what's going to happen? It doesn't apply to economic risk. For unit protocols, you can run a lot of simulations. For multi-protocol, I think it's computationally unviable. Like it's just hard to combine different protocols and run simulations and make sense of it. And machine learning, yes, applies to technical. We think in the future might apply to governance, certainly not today. Governance is paper, right? Economic risk, for sure, you can run transactions and classify it on risky or not on both to unit protocol and multiple protocols. Now, all this is a good theoretical framework, right? How to think about it, technical, economic, governance risk, and then a symbolic machine learning or a simulation approach for single protocol or multiple protocols. We think that that type of methodology applies. So let's look at a specific examples of this. Everything I'm going to show you is in our DeFi Risk Radar alpha release. It's still weeks away to go into production, but you can check it out. So in lending protocols, risk conditions are often related to liquidations and market compositions. So for instance, one thing that we looked at, I'm going to try not to talk too much about the protocols, but for instance, you can look at the history of liquidation. What you're looking at the screen is the Euler hack. So this was the sequence of liquidations that trigger. If you've read the reports, the hacker found a vulnerability in which he was able to liquidate himself and then borrow assets based on a specific aspect that the protocol needs to check. In that case, so the attack was triggered by a ton of liquidations, and this is we got the alert sort of the next few blocks after it happened, but certainly saw it very fast. Then you can look at things like high-risk loans. So this is another practical example. For instance, when USDC depeg earlier this year, we had to exit a lot of our lending positions for our clients because high-risk loans were accumulating in lending protocols at an alarming pace, and that means that you could get massive cascaded liquidations and things like that. Then at any given time, you can look at liquidations in a given. This is a real time snapshot of a lending protocol. You can see that there is certain decent amount of capital that could be liquidated in the near future. Whales is an interesting one for large holders. When they get in or out of a position in a lending protocol, they alter the composition of those markets. So it's another risk factor. And like those, there's hundreds, right, that we typically looked at. AMM protocols are typically related to non-liquidations, but other aspects like pool compositions, slippage, depegging scenarios. So for instance, in pools, when we have, you were using synthetic derivatives, right? In this case, it's an STE, so staking derivative. We monitor the pegs very closely, literally block by block, in order to make decisions. Then about the pegging events, right? This is a programmable stablecoin. How many times it depegs and what has been the impact and what is a simulation of that. Then concentrations of pool. Many of these liquidity pools, you see, okay, there is 2 billion in that pool, but who is there, right? And we look at other protocols that have. So these are in a specific protocols like Curve, Maker, Convex are actually holding assets on that pool. So that's the composition, and it could be a risk condition because it's an indirect exposure to that protocol. Obviously, slippage, you're in a position in an AMM, you want to exit. Sometimes the pool composition change and you need to exit holding an asset that you don't want. What is the exit fee that you need to buy? How does that change? If whales remove capital very quickly, then you can suffer very massive slippage from one block to the other. So monitoring this is quite interesting. And then there's dozens of categories. So an area that we have been doing a lot of work is programmable stablecoins, because there seem to be one of those every week now, very good ones. Bridges, obviously, is super interesting because you move capital through bridges, and it's probably the #1 attack vector in DeFi. And obviously, protocols, derivative protocols are getting some traction. So it's areas that we're spending time modeling risk as well. Now, the last 2 minutes, I want to leave you with an ambitious idea about risk. So we talk about 3 approaches: symbolic, based on rules, simulations, right, based on traditional statistical or sort of evolutionary simulation techniques, and then machine learning. In the last year or so, right, we have seen an explosion of this trend that we call foundation models, that are the GPTs of the world, right? The large language models or the large diffusion models in computer vision, and it's pushing. So the boundaries of what we believe is possible. Now, the current generation of what exists today, with models like GPT-4, Claude, Facebook, Meta unveiled Llama yesterday, they have shown capabilities in areas such as coding, language that is obviously relevant to DeFi, but they're also shown capabilities in things like causal reasoning. Like you can give some of these models a batch of data and try to infer causal relationships between it. There is a famous paper, not famous, a very well-read paper from Microsoft a few months ago that explained show a ton of experiments about causal reasoning on language models, and it's mind-blowing the things that the patterns that it can identify. But the key about these models is that they're typically trained on a lot of unlabeled data. Like you don't have, it's not a traditional supervised learning approach in which you need to say, this transaction is fraudulent, risky, and this one is not, this one is risky, this one is not. Tell me, is this one risky or not? Here, you can just give it a bunch of transactions and it will start learning things that you didn't anticipate it. But then once trained, you can do this process that is called fine-tuning, that in which you can essentially adapt the model to specific scenarios. So practical examples is you're seeing firms adapting GPT 3.5 that is fine-tunable to fine-tune it with law libraries, right? To be more specialized in legal concepts or economic concepts or medical concepts and things like that. So here's the idea. So imagine that you take all the white papers about DeFi protocols, all the smart contracts, because these models are good at coding, they understand solidity and things like that, all the blockchain transactions, and also past exploits, right? All the history of all the hacks that has happened, the blockchain records of that. And you fine tune an LLM for that. What you're gonna get is a DeFi and a foundation model specialized on DeFi risk. And then you can fit that one different blockchain transactions and identify if there is a risk condition. The reason this idea is interesting is because the unknown, right? Like these models exhibit properties at a scale that nobody anticipated. So probably the way some of these models are gonna reason about risk are not exactly the same way that we're reasoning about risk at the moment. So you can it can lead to very fascinating risk management scenarios. So I think it's definitely an idea worth exploring. So a fine-tuned version of this is what I'm saying in terms of causal reasoning and prediction could unlock some new scenarios that we're not anticipating today based on real-time blockchain activity. All right, so to wrap it up on time as usual. So there are three fundamental types of risk in DeFi protocols: technical, governance, and economic. Economic is by far the most relevant, and it will become more and more relevant, and it's probably the one that doesn't get that much press. Key approaches to manage risk in DeFi, the three main ones is symbolic, using rules, simulations, and machine learning models. And the new generation of foundation models is definitely opens all sorts of opportunities for DeFi. I know this was a very deep topic. I would love to go to questions now. Before that, I want to announce the next webinar. We're going to be talking about the new ecosystem of programmable stablecoins. We have done a lot of work on Avego, on CRB-USD, on things like that that are coming to market. Our head of research, Lucas Otomoro, I believe is going to be leading that webinar. We're going to show you a ton of interesting stuff. So with that, I would like to go to questions. If you want to sign up for the webinar, the link is there on the chat. So if you have questions, please use the Q&A panel. Yeah, so Deepak is asking, how can particularly implement 3 techniques in my daily trading? Is that possible? Yes, it is actually. It's hard though. That's the thing. It requires a ton of infrastructure. The reason we're building the risk radar was to give institutions to have the same risk visibility that we use in our trading. So check out DeFi risk into a blog.com. It's an alpha release, it's a preview, it's not the final product by any stretch, but it gives you an idea of what, and you're gonna be able to use a lot of that via APIs. And then, but also it's gonna give you a lot of ideas of what can be built. Thank you, Ivan is saying thank you for the insightful presentation. Thank you very much. Any other questions? Questions going once, questions going twice. All right, well, thank you very much, guys, and I hope to see you in 3 weeks.